the Kaya Association, Chartered Alternative Investment Analyst. And I'm excited to be here with you today to talk about the world of alternative investments. And so when Kaya talks about the world of alternative investments, we look at hedge funds and managed futures, structured products and credit derivatives, of course, private equity, venture capital, and private debt, as well as the whole world of real assets, so real estate, farmland, timberland, and infrastructure. So Kaya started in 2002. We're headquartered in Amherst, Massachusetts, but we're really global in nature. We have over 11,000 charter holders in about 95 countries. And so we educate the world on alternative investments. And we believe that alternative investments have been growing substantially over the last 20 years, and that growth will likely continue in the future. So Kaya has a level 1 and a level 2 exam that result in our Kaya charter. So they're both exams, level 1 and level 2, are offered in March and September. They're about 200 hours of study each, with about a 55 to 65% pass rate. And when you're done, you'll be a globally recognized expert in alternative investments. We also have a shorter form program, a 20-hour video-based course that gives you the fundamentals of alternative investments. So this is meant for 100% pass rate. And you'd watch a 1-hour video, you take a 10-question open book quiz, and then you move along to the next. So it gives you a nice grounding in alternative investments. We see that many students will take this program before they go out on the job market to give them the basics of alternative investments. So as we look around the world, we try to break things into traditional investments relative to alternative investments. And so traditional investments are basically stocks and bonds and cash, and alternative investments are basically everything else. So private equity and hedge funds and real assets and structured products. But since 2008, people have made a lot of money on their stock portfolio, and they made a lot of money on their bond portfolio. And so with equities at all-time highs and interest rates at all-time lows, there's concerns with how we're going to make returns going forward. So if we look at what's happened since 2008, since the before the global financial crisis, we saw that a U.S. portfolio invested 60% in stocks and 40% in bonds, had a return of 7.5% per year, with a drawdown of 21% over that same time period. But people invest in alternative investments to diversify their portfolio, that is, to do something differently, and they invest in alternative investments to enhance the returns on their portfolio. So you see that private equity, venture capital, and farmland since before the GFC actually had higher returns than global stocks. We see that that real estate had a return similar to 60-40, and then commodities and hedge funds had lower returns. But if we built a global alternative investment portfolio, we see that the drawdown for that was 17%. So investing in alternative investments could be higher risk if you're investing in venture capital and private equity, but it's actually lower risk if you're investing in infrastructure and hedge funds and real estate. So we really want to diversify our portfolio. So the problem is that as stock prices go up and bond prices go up and bond yields go down, it's getting harder and harder to make what pension funds assumed was their required return. So 20 years ago, we saw pension funds assuming returns of 8.25, even 8.5%, and now those assumed returns are 6.5, 7, and 7.25. And so as returns are declining, we're seeing people move out of equities, and especially out of fixed income at these low rates. So every investor around the world seems to be doing a number of different things. The first thing that almost every investor in the world is doing is investing more money outside of their home country. Second thing, almost every investor around the world is doing is investing more in alternatives. And the third thing is they're investing less in investment grade public fixed income. They're moving into other yield alternatives like real estate or infrastructure, or into the private debt market. So it's in your best interest to really engage with alternative investments. So our estimate is that the traditional investment market around the world about 102 trillion dollars, and alternative investments are over 13 trillion dollars. But when I earned my Kaya charter in 2003, we saw that alternative investments were about 6% of global wealth, and now it's about 13%. So over 15 to 20 years, alternative investments have doubled their share of the global investment market. But we also see that there's been substantial fee compression in the long only stock and bond world. That trillions of dollars are moving from active funds into index funds, and so the fee burden on equity and fixed income is continuing to decline. But in some areas of alternatives, the fees have been relatively stable. So now, even though alternatives are about 13% of world wealth, it could be as much as 50% of global asset management fees. So the fee income from alternatives is strong, and that means that the job market for alternatives is strong. But there's not enough people who are really trained to take these roles in alternative investments. So we have a lot of friends that help us out with data. So in here you'll see data from Preqin and from HFR, and we look at private equity and real estate as the core alternative investment classes. That the majority of institutional investors, who are pension funds, sovereign wealth funds, endowments, and foundations, the majority of those large investors have allocations to both private equity and real estate, but only 30 or 40% have allocations to private debt, hedge funds, infrastructure, and natural resources. Among those who do have an allocation, we see that it's about 11% in private equity and 9% in real estate. So the average investor might have 20% allocated to alternatives, and then we see that the average allocation to hedge funds about 12%, and then private debt, infrastructure, and natural resources about 3 to 6%. But we see that investors are really focused now on growing their allocations specifically to private equity, private debt, and infrastructure. And we might have reached the peak allocation of hedge funds. So some of the most aggressive investors in the world in alternatives are the universities with larger than $1 billion in their endowment. So this is Harvard, Yale, Stanford, MIT, Texas. On average, they're investing 57% of their assets into alternative investments. The largest is hedge funds, and then private equity, but you see a substantial allocation to real estate and natural resources, because the university endowments are very focused on inflation, and it's the natural resources in real estate that are going to give you that inflation hedge. We see that sovereign wealth funds are now a $9 trillion market. These are funds like the Alaska Permanent Fund, or the Norway Sovereign Wealth Fund, CIC in China, or Temasek in Singapore. Now they have $9 trillion in assets. So they've continued to grow their wealth, and they've continued to grow their allocation to alternatives. So now they're coming up on $2 trillion of assets invested in alternatives, which again is a huge portion of that $13 trillion global alternatives wealth. But you see here that every investor has a different asset allocation. We see that sovereign wealth funds are focused on private equity and infrastructure. Endowments and foundations have a larger weight in hedge funds, and then real estate is most popular in public pensions. So every investor engages with alternatives in a different way. So the reason to put commodities in your portfolio are for diversification and for inflation hedging purposes. We saw that commodities have had a negative return since 2008, which is amazing given the large return to the global stock and bond markets. So clearly, most investors are now underweighted in commodities, but we know that commodities over the long run have risk and return similar to equities. So commodities actually beat equities for the entire decade of the 70s, as well as the entire decade of the 2000s. So when investors engage with commodities, they're building a diversified portfolio. Maybe you're tracking the Bloomberg Commodity Index that's relatively equally weighted in energy and food and metals. So we believe that the commodities have perhaps the best inflation hedging potential, but they're also relatively uncorrelated to stocks. So if you look at the worst month each year of stocks, we see that global stocks fall more than 6% in their worst month of the year. But look at the diversification you could get from alternative investments, and so basically you'd earn a zero return, maybe plus or minus 1% in investment grade bonds, in high yield bonds, in commodities and managed futures, and real estate, and some forms of hedge funds really are kind of plus or minus 1% in these worst months of stocks. And so it gives you a lot of downside protection. So as you move assets from stocks into these other asset classes, you're reducing your risk faster than you're reducing your return potential. But we worry about correlations because commodities are highly diversifying to our stock and bond portfolio at times when their correlation is low. So through most of the 90s and the early 2000s, we saw that commodities had a correlation of stocks between plus 0.2 and minus 0.2, essentially zero. So that's highly diversifying to our portfolio. But we were worried in 2008 that there was a large drawdown in commodities at the same time as a large drawdown in stocks. So we didn't get that diversification potential that we would like. But when we invest in commodities, it's important to diversify between metals and energy and food products, because the return to a commodity basket and the inflation hedging characteristic of a commodity basket is relatively the same as it is to the energy sector, but that commodity basket has literally half of the risk of investing in energy alone. So you get a lot of diversification potential with again without giving up return and inflation hedging potential as you add metals and food to your commodity basket. So we've seen that that commodities have had a negative return since '08, and commodities have had a very positive return. And so we have the lowest valuation in 20 years of commodities relative to equities. And so if you think that there's been a lot of monetary stimulus, a lot of fiscal stimulus coming into the market, if you think that interest rates might rise and inflation might rise, commodities are extraordinarily cheap relative to stocks and bonds. Moving along to hedge funds, as we look at alternative investments, we're looking to diversification. And when we look at diversification, we'll see that when we're looking at different risk factors, we are looking at diversification. And so there's not a real concern with interest rates in hedge funds, which means that that's going to be diversifying relative to your fixed income portfolio. So we see that the global private hedge fund market is about $3 trillion, and that has grown substantially, uh, more than doubling since the bottom in '08 and '09. What's interesting to note is that new money was added to hedge funds basically every year from 1990 to 2015, with the obvious exception of 2008 and 2009. But we've basically plateaued in the assets in private hedge funds. And you see that 2016 to date, there's been growing outflows into that from that hedge fund sector. Part of this outflow is going into liquid alternatives. So when we talk about the private hedge fund business, that's for high net worth individuals and institutional investors in long-term private funds. But there's been a growing assets under management in liquid alternatives. So these are funds that are available to retail investors. They're managed like mutual funds according to the US 40 Act or UCITS in Europe. And so now, as a mutual fund investor who's not a high net worth investor, you can get all of these investment objectives in your mutual fund portfolio. You could do long short credit, you could do long short equity, you could do real estate, commodities, currency, and inverse funds. All are available in this liquid alternative format. And so we've seen over the last few years that while the assets in hedge funds doubled from '08 to present, we see that the assets in liquid alternatives are up by a factor of more than 4 times. And so now liquid alternatives are fully 1/4 of the global hedge fund business. So we've stabilized in the number of single manager hedge funds at above 8,000, but we've seen a continued decline in the fund of funds business. So we've liquidated or merged more than 1/3 of fund of funds since 2008, even as the industry has grown assets and the number of single manager funds. And so earlier this year, the first quarter, we saw that 81% of fund of funds had outflows in the first quarter of this year. So if you are anticipating a career in alternative investments, you might want to be careful about the longevity of the fund of funds you join. Now, this is one of my favorite slides in the deck, looking at the concentration in the hedge fund industry. So if someone tells you they work for a hedge fund, or they even if they run a hedge fund, it doesn't mean they're rich, because 48% of the number of hedge funds, almost 4,000 hedge funds, has less than $100 million in assets. And those 4,000 hedge funds are fighting over just 1.2% of that $3 trillion asset management pie. So there's really huge returns to scale in the hedge fund business. So if you look at the orange, the turquoise, and the purple slice, we see that 26% of hedge funds have over $500 million in assets under management. And those 25% of hedge funds control about 95% of the assets under management. So because the hedge fund business is so institutional, the sovereign wealth funds, endowments, foundations, and pension funds, they're typically allocating the vast majority of their hedge fund assets to the funds that have over $500 million in assets under management. So we saw that that hedge funds and bonds had similar returns since 2008, which means hedge funds are not giving you substantial returns. So now there's been concerns about the fees that hedge funds have been charging. Historically, they wanted to earn 2 and 20, which is 2% of assets every year plus 20% of gains without giving back any for the losses. But investors said, well, that's not really fair. If your gross return is 6% and you take 2 and 20, that only leaves me with 2 or 3%. And so now we're trying to change those fee structures. Maybe we reduce the fees to 1.5 and 15, or what's most interesting is 1 or 30. And so if you're going to give me a 6% gross return, I'm just going to pay you 1% because now that's just like a bond-like return that you're giving me. But if you're going to give me 10, 20, 30% gross returns, I would gladly give you 30% of that as an incentive fee because you're offering me very strong returns. Now, this is kind of a messy chart, but I'd focus on the kind of the flat lines from 2008 to 2016 above zero point 0.8 or zero point 0.9, which basically says from 2008 to 2016, we were worried about the global financial crisis. We were worried about QE and the risk on, risk off trade. And if every stock in every sector has a correlation of 0.8 or 0.9 to the index, it's really been difficult for the hedge funds to make money. But notice that since 2016, as we came into Trump's first and now likely only presidency, that volatility increased. And so Trump's presidency was actually good for hedge funds because it was a stock pickers market, that there was greater volatility between stocks, greater volatility between sectors, and stocks would move big just on a tweet or a policy change. So it was hard to make returns for hedge funds, 08 through 2016, but the last 4 years, there's been greater dispersion. And that's what you like as a hedge fund manager. You like higher volatility and higher stock picking markets. And so if you had the vaccine trade on just yesterday, if you were long airlines and drug companies and Disney and cruise lines, and you were short Zoom and video game and the stay-at-home stocks, you actually made over a 20% return in one day based on that sector dispersion. Moving along to private capital, we could look at private equity, private debt, real estate infrastructure, and natural resources. So that's an $8.6 trillion market. But what's concerning about that is 2.8 trillion is held in dry powder. So we saw earlier from the Preqin survey that 40% of investors want more private equity, they want more infrastructure, they want more private debt in their portfolio. And so we see that investors are giving money to these managers faster than the managers could put this to work. So in 2016, the dry powder was 1.8 trillion, and in 2019 it was 2.8 trillion. So literally, of the $3 trillion that was invested in those funds over the last 3 years, 1 trillion of that is still held in dry powder on the sideline. So dry powder is capital that's been committed to these alternative investment managers, but not yet invested. And in private equity and private debt, that capital stays with the investor until it's called from the general partner or asset manager to be invested in that asset class. So we're concerned about asset valuation and competition for assets in private equity. So maybe part of the reason that this $1 trillion is held on the sidelines is because we have had a big bull market in stocks and valuations have been high, and so maybe the GPs were reluctant to put that money to work. But there was again tremendous opportunity over the last 6 months in a pandemic sense to rescue companies or buy companies out of distress. And if you believe that the pandemic is ending, you could have added a lot of value to your investors by providing liquidity to those distressed companies. So specifically on private equity and venture capital, that's a $5.1 trillion business with about 1.7 trillion. Again, 1/3 of that is held in dry powder. So the problem here is that the red line is taller than the blue line. So you see 2013, 2014, 2015, 2016, 2017, for 5 years in a row, the capital distributed by private equity was actually larger than the capital called up. So when you invest in private equity, you're investing in a 10-year fund. So the general partner is going to invest for a 10-year period. They're going to buy these companies, grow these companies, and maybe they'll have a 5-year holding period. And then comes the exit. So in the second half of this 10-year fund, the general partner is looking to sell their venture-backed companies as an IPO. They're looking to sell their buyout companies to a strategic buyer. And for 5 years in a row, the money coming out of these exits was greater than the capital that was being put to work in new companies. So as investors were putting more and more money into this space, the sector was actually growing because capital being distributed was more than capital calls. But 2018, 2019, the exits slowed down a little bit and the investments sped up. So some of that money was being put to work. Uh, it's very important to be educated on alternative investments. Don't invest in private equity or hedge funds without a significant amount of education. Maybe that comes from fundamentals, maybe that comes from Kaya, or from some programs that Wave might be doing. But notice here that the blue line is higher than the green line, and the best venture capital and private equity managers in the top quartile, they might have returns of 20 or 25% per year compounded over 10 years. And the bottom quartile, the bottom 25% of managers is just 10% or even less. So investing in the best managers gets you more than 20% a year, and investing in the worst managers gets you less than 10% a year. That spread is higher than the total return to the equity market. So it's amazing the tremendous dispersion in returns between the best and the worst managers. We see that venture capital deals are declining in number, but they're increasing by size. And what's fascinating is how we've been globalizing this market. If you look back at 2013, 2014, we see that the blue line and the red line are almost the entirety of the venture capital money being put to work was all in North America and in Europe. And you come to 2018, 2019, in places the green line is higher than the blue line, which means there is more venture capital money being put to work in China than in the US over these years. So we've seen a tremendous globalization of this venture capital business. And we know that that money is being put to work not only by the American and European GPs, but also by native Asian companies, whether it's Alibaba, Baidu, Tencent, and SoftBank. They're very big players in this as well. Moving along to natural resources, again, you'll see very different risk drivers here. Commodity market volatility is a key focus here. And when you invest in natural resources, you're investing specifically for the income as well as the inflation hedging potential. We see that you could invest in metals and mining. You could buy a gold mine. You could invest in energy. So you could buy an oil well or build a solar farm. You could invest in farmland and timberland. There's a lot of very interesting places that you could invest. And while the focus on venture capital is larger moving to Asia, what we'll see in natural resources and in private debt, that focus is still very strongly in the North American and the European markets. We see that investor focus is largely on energy. Almost all natural resource investors have investments in energy, but that's increasingly split between fossil fuels and renewable energy. And we're still making new deals in fossil fuels, and we're still making new deals in renewable energy. We know that as oil prices go up, renewable energy, the wind farms, the solar farms, hydro become increasingly competitive. But as energy prices go down on the fossil fuel side, that makes renewables less attractive. But of course, we might be getting some new policy focus on renewables in the U.S. during the Biden administration. Now, we could also invest in private debt, which has been tremendous growth in assets, 20 times over 20 years, or more than 4 times after the end of the GFC. So what we're doing in private debt is we're investing in things that are not publicly traded bonds. We can invest in mezzanine. So the mezzanine opportunity within private debt is lending money to leverage buyouts. And so we see that a leverage buyout might happen at 10 times EBITDA at a 50% equity contribution. So 5 times EBITDA would be the price of equity, and then 5 times EBITDA would also be the debt that we're investing. But an investment grade company in the public market might only be able to get 2 to 3 times EBITDA as a debt load. So to get from 2 times EBITDA to 5 times EBITDA as a debt load, you have to go into this private debt market. This year, there's a substantially increased opportunity in distressed debt, especially in the shutdown sector. So travel and tourism and restaurants and retail, there's a lot of distress in that space. So you could buy in as an investor to that debt. But there's a tremendous opportunity in direct lending as well. So after Basel III in Europe, after Dodd-Frank in the US, as we're recovering from this GFC, we put a lot of restrictions on the banks to lend to speculative grade middle market companies. And so now those companies really can't get financed by banks. So now they're going directly to the hedge funds and the private equity funds to directly take loans from them rather than the bank. As I said, private debt is largely a North American and European focused opportunity. We see that distressed debt has really been a focus this year. So the number of investors who are looking to do distressed is literally up 50% year over year. And so there's this tremendous opportunity to put money to work at substantially lower valuations. So private debt and private equity really was growing that dry powder because they saw a lack of opportunities at a fair price. But the pandemic changed that. And so you had an opportunity to buy on the real estate side, office and retail was substantially marked down. Those debts started being non-performing. We weren't paying the full rent on our spot in the mall, and that creates opportunity for these distressed investors. So moving along to infrastructure, infrastructure tends to be a lower risk than equity or private equity, but a higher cash flow than fixed income. And so in private infrastructure, now what you're caring about is the deal flow, that there's not necessarily enough assets that are available to be sold. So again, you see that assets are up more than 5 times, 6 times in infrastructure just since 2008, $660 billion business. And so we're seeing that just like real estate, there's different ways of putting risk out into the market. So core and core plus are the lower risk, the stabilized properties. Value added and opportunistic might be you're buying an underperforming asset or building a new asset. So there's a lot of ways you can engage in the infrastructure sector. But what infrastructure is you're investing in airports, you're investing in cruise ports, you're investing in the electric company, the water grid, the toll roads. And so to the extent that it's the electric company and the water company. Those are relatively low risk assets that really don't vary uh, with GDP. And so you could go into a recession, you could go into a COVID lockdown, but people are still using water, they're still using electricity, they're still finding a way to pay those bills. And so that's a lower risk, higher cash flow way to invest in the markets. We're concerned about valuations in real estate, but there's been a tremendous sector rotation in real estate. So we see that uh, there's been very good performance of apartment buildings, very good performance of data centers and cell phone towers, very good performance of e-commerce logistics, warehouses. But on the other side of that, offices have been difficult, and for a very long time, brick and mortar retail has been a difficult place to invest. As we moved to e-commerce before the pandemic, shopping malls were challenged. So there's been a big spread in returns across the different types of real estate assets. So within these strategies, again, there's core and core plus. These are the buildings that you could invest in. They're 80+% leased by tenants that are paying their rent. They're relatively low debt, and so these look more like a bond investment because they're lower risk and higher cash flow. When we look at value added and opportunistic, that's more of a risky equity like investment. We're flipping houses, we're buying properties that are 1/3 leased and trying to take them to 2/3 leased, or we're developing those properties. If I could go back a couple of slides, uh, there's a question in the chat. What does unrealized value mean? And so when you commit to these funds, you're investing for a 10-year period, uh, and you're taking capital and you're committing capital. So I commit $10 million to an infrastructure fund or a private equity fund, and they might call $5 million in the first year and $2 million in the second year. So after 2 years, I have $7 million invested. That's going to be my unrealized value. And then I have $3 million uninvested. That's going to be my dry powder. So unrealized investments are the investments that are currently in the fund. Those investments have been made, but they've not yet been exited. And so after a company is sold in an IPO, it's sold to another infrastructure fund, another private equity fund, or it's sold to a strategic buyer in that industry. It moves from the unrealized value into the exited value, and that cash is typically returned to investors. So the capitalization rate on real estate is the net operating income relative to the price of the property. So it's the rental income you earn net of taxes and operating costs, but not net of debt service, because we value buildings on an unlevered basis, assuming that it was fully paid, because you wouldn't want to have someone with leverage valuing the property at a different value than someone who fully pays for the property. So when we value real estate, we do that at a capitalization rate, which is basically the cash coming out of the property. And so that 10-year treasury yields used to be 2%, and now they're sub 1%. And so as interest rates decline, we'd expect that the cap rates on real estate would also decline. That might come from rising property prices or from falling income on those properties. You see that the safest one with the lowest yield is multifamily, and so you might get a 4% yield by investing in apartment buildings, and then the retail and industrial, those are perceived as being more risky. So you'd earn a 5% yield on that. And so you see that in investing in real estate, you're expecting to earn a yield maybe 3 to 5% higher than the 10-year Treasury. Now, these cap rates differ based on whether you're investing in office or retail or industrial, or whether you're investing in Europe or Asia or Americas. And so you know that all real estate is local. Everything's all about the location, and different locations around the world have very different views of risk and return in real estate. So we see that some of the most expensive real estate in the world is in Hong Kong, and investors in Hong Kong a couple of years ago were willing to invest in retail and office properties just for a 3% yield, a very low yield. But you saw the same types of properties in Chicago or Los Angeles were yielding 4 to 6%. So depending on where you go in the world, the yield varies tremendously. Probably in hindsight, the best opportunity on this slide was probably 3 years ago. You know, a 7 or 8% cap rate on real estate in Frankfurt. That was a great opportunity with Brexit as people moved from London to Frankfurt, and there was some great bargains to be had in that market. We know that again, real estate also has that issue of rising dry powder, and most of that dry powder is in the value added and the opportunistic. When people kind of back off of the most risky real estate projects, that tends to be in dry powder more often. The Kaya program also talks about structured products and credit derivatives. So we look at credit default swaps as well as CDOs, CLOs, and CMOs. So we could look at commercial mortgage-backed securities, which are bonds that put together loans on individual commercial properties, and that sector had tremendous growth going into the GFC, growing from about 80 billion in '04 to 230 billion in '07. Obviously, that got hurt by the GFC going to literally zero in 2009. But this market hasn't come back. So the 2019 volume was pretty similar to the 2004 volume. So we never got back to those pre-GFC highs in investors wanting to invest in securitized commercial properties. But if we want to look at collateralized loan obligations, here we're looking at, again, loans to these middle market companies, student loans, car loans, credit cards. While we're not that interested in investing in commercial real estate, we're making new highs investing in CLOs in the US and Europe. So that seems to be somewhat risk seeking when we're more interested investing in car loans and student loans than we are investing in commercial real estate. So that's the prepared remarks about the alternative investment markets. Let me take a look and see what's in the comments. I could take a couple of questions on this material, and then I have a couple of minutes of prepared remarks, a little more about Kaya. So the first question is why is there an outflow in private hedge funds over the last 5 years? And I think part of that is due to basically disappointing returns in hedge funds. We saw that that returns over the last 10 years to hedge funds have netted investors, maybe 4%, which is much lower than we had in public equity, lower than private equity, lower than in real estate, farmland, timberland. And so hedge funds are kind of a lot of complexity and a lot of risk to earn bond-like returns. But part of that outflow of assets from private hedge funds actually went into the liquid alternative space. So the assets in hedge funds and liquid alternatives combined today are at all-time highs. And so part of the outflow was moving into assets with higher returns, but part of that outflow was simply shifting from private hedge funds to more public hedge funds in the UCITS and 40X space. So how is real estate different today than in 2008? So what happened to real estate during 2008, and what happened in real estate today? So in 2008, we were taking tremendous risk in real estate, and we were basically making loans to people who shouldn't have been buying properties. And so the 2008 financial crisis was largely focused on subprime residential real estate. And so we were allowing both investors and residents to buy houses and properties that they really couldn't afford to buy. So we were giving loans to people who had a history of not paying their bills. And once we figured out that they weren't able to pay their bills, you had a lot of defaults coming into that real estate space. And so as people were buying more and more real estate, the price of real estate was going higher and higher. But it was actually those people who couldn't afford the properties who were driving the prices higher. And when we stopped making loans to those people who were unable to service that debt, that marginal buyer stepped away. And so now there were fewer people who were willing to buy those properties. And so the prices declined relatively quickly after that. Today, what we have in real estate is a crisis in office and retail real estate. If we close down, 1/3 of small stores and 1/3 of small restaurants, maybe in the world, it's going to be very, very challenging to get a good rent for the vacant properties or even the properties that continue to be occupied. But investors have earned actually good returns this year by investing in data centers and cell phone towers and Amazon warehouses and residential real estate. And so we're seeing a big increase in returns to residential real estate because if everybody's working at home, they want to have a nice home. And so they're either upgrading their home in their current location, but I think there's a big downside from work from home for the residential markets in San Francisco and New York. And so you're saying, oh, I was living in San Francisco, I was living in New York, I could afford to buy a $1 million apartment because I'm making this great salary. But now, if Facebook or Google or Goldman Sachs is going to let you work at home, maybe you'd rather live in Montana or Tennessee to earn that same salary. So we might see a boom in residential real estate in the suburbs and in southern states, and maybe a risk to California and New York in the real estate market. Are opportunities in distress investing sustainable? How's it going to change? After COVID, there's always opportunities in distress, but it's very cyclical. So you see, there's a lot of opportunities in distress when tech companies go bust in 2000, or real estate goes bust after 2008, or maybe the hotels and the airlines had risks this year. It is very cyclical, but the distressed investing now is politically we're still looking for more stimulus, because I wrote an article in Real Asset Advisor in March, looking at what the stress might be in retail and in office. And so I think distressed investing in office properties might be sustainable because if we continue to work from home, if 20% of the people from offices continue to work from home, that's going to be an oversupply of office. So there might be continued opportunities in distress. For pension funds, why would an increase in stock and bond prices cause pension funds to decrease the percentage of their investments in traditional investments? Shouldn't it cause them to increase their percentage? So if you're a buy and hold investor and you're investing in stocks and bonds with maybe a pre-existing investment in real estate and hedge funds, if stocks and bonds have higher returns than real estate and hedge funds, you are going to take share and grow your investment in the percentage held in those traditional stock and bond investments. But what investors tend to do is rebalance. And so you have a regular weight on investments in your portfolio. It might be 40% in stocks, 40% in bonds, and 20% in alternatives. And your job as an institutional investor is to stay close to those weights over time. And so if you stay close to those weights over time, that means you're selling the investments that have the highest returns, and you're buying the investments that had the lowest returns. So what you should be doing is you should be selling equities and buying commodities. And so there's one change in your portfolio that's based on buy and hold, and another is based on rebalancing. So how would you recommend we learn more about a career path in alternatives? How do we choose between hedge funds, venture capital, and private equity? And so at this point, I could kind of go back to my presentation and talk a little more about Kaya. So the Kaya Association is focused on education in alternative investments. So we have the level 1 exam and the level 2 exam. They're about 200 hours of study. But we also have the fundamentals of alternative investments, a 20-hour video-based course. So at level 1, you look at each of these asset classes individually. So you'll learn about hedge funds and managed futures, commodities and real assets, structured products and credit derivatives, private equity, private debt, and venture capital. The level 1 book looks at each of these assets individually from a bottom-up basis. So the level 1 exam is a 4-hour exam. You'll have 100 multiple choice questions in 2 hours, followed by a second multiple choice 2 hours of 100 questions. You see about a quarter of that exam is on kind of the math and theory of alternative investments, about 20% on professional standards and ethics from our friends at CFA Institute, which leaves about 55% on those 4 categories. And then on level 2 is our top-down, our allocator approach. So in level 2, you learn about sovereign wealth funds, family offices, pensions, endowments, and foundations. You learn about how environmental, social, and governance issues work in alternatives. Then you look at asset allocation, risk management, liquidity, and manager selection. Your level 2 exam has, again, 100 multiple choice questions in 2 hours, and then you have 2 hours to answer 3 constructed response or essay questions. One essay question is on a group of 8 articles in the current and integrated topics. One essay question is on ethics, regulation, and ESG. Then the third essay question is from the textbook. So you could buy the textbook in hard copy or in a Kindle ebook or through the Wiley digital learning platform. So most people will start their Kaya program at level 1. And after you pass the level one exam, you move along to level two. But if you're a CFA charter holder, you may be eligible to start the Kaya program at level two. So visit our Kaya website to find more about our program. So you can download for free the study guide, the workbook. You could look at those to figure out what's going to be on the level one exam, what's going to be on the level two exam. You could come to a 1 hour webinar, what is level one, 1 hour webinar, what is level two, and then registered candidates have access to full length sample exams. So the level one and level two exams are about 200 hours of study for each exam. Pass rates at level one have been around 55%, and level two has been around 65%. And there are fees involved with that level one and level two exam. You get $100 off if you register for your exam by November 16th. The level one exam is offered in late February and early March, and then the middle of March is the level two exam. And we're assuming that that March still might have some COVID restrictions, so you might be eligible to take the exam in your home or office, as well as at the proctored exam center. But back to your question, how do I learn about alternative investments? You could take that year of intense study to become a globally recognized expert in alternative investments. You'd be a Kaya charter holder. You put it on your CV. You put it on your LinkedIn. But you have the ability to engage with Kaya today. So pre-pandemic, we were doing 150 live events a year in more than 20 global financial cities. But now that content has moved online, so we're probably going to do over 100 webinars this year, and all of those webinars are available to you. Some are on hedge funds, some are on real estate, some are on private equity, some are on why alternatives are continuing to grow. And so you could visit the Kaya website. You could read the All About Alpha blog. You could register for those webinars as well. So I think we've reached the end of our time. I'd like to thank Wave for our time, that we've been able to share this state of alternative investments. Hopefully this has got you started on your knowledge of alternative investments, and feel free to engage with the Kaya exam, the Kaya webinars, or the fundamentals program to get up to speed on alternative investments. So thank you, everyone, and I'll leave you here for your next webinar.